We're delighted to have you here. Join us today. We've got a very informative session. My name is John Jacobs, and I'm one of the co-founders of the ETF BILD Project, our a little think tank that we've developed in order to surface the issues or raise the issues and perspectives that we think need to be raised in the ETF industry today. Today's event is, can the SEC mainstream ESG investing? And we're going to talk a lot about that. As everyone knows, the SEC has put a new rule out there, and we're going to hear extensively about that new rule, and then we're going to get some perspectives. I'd like to make this as interactive as possible, so please use the Q&A function or the chat function, either one, and go ahead and submit a question as we go. Format will be, Bib Strench is going to do a quick overview of the rule, and then I'll turn to all three of our panelists, and we'll go through some questions. But I'm happy to weave other questions or audience comments in as we go, so please utilize those two particular functions. So as I said, my name is John Jacobs. I'm a longtime veteran of the industry. Was at NASDAQ for 30 plus years, Georgetown, and serve on a variety of different boards today. Joining us today are our three panelists: Bib Strench, who's a partner with Thompson Hine; Jeff Gitterman, who is a co-founding partner of Gitterman Wealth Management; and Patrick Reed, CEO of Your Stake. So, gentlemen, I'm going to have each of you introduce yourselves for a moment, a little bit more about your firm. So, Bib, let's start with you.
Yeah, thanks, John. Like John says, I'm a partner at Thompson Hine. We have a number of practice areas, including investment management. I focus mostly on registered funds, mutual funds, ETFs. As you can imagine, I've been dealing with a lot of ESG issues, my clients have. And I started my career at the SEC way back in the late 1980s. So I've seen it from the other side and understand rulemaking and what they're trying to achieve. But this rule, as we'll get into, has been, I think it's going to be particularly challenging for the agency.
Great, thanks, Bib. Jeff?
Hi, I'm Jeff Gitterman. I am CEO of Gitterman Asset Management and partner of Gitterman Wealth Management, focused on providing sustainable and ESG and impact investing towards clients and other firms that use us as an outsourced CIO. I'm also host of the Impact at fintech.tv, which is broadcast live at the New York Stock Exchange.
Great, thanks, Jeff. And Patrick.
Hi, I'm Patrick, and I'm a co-founder and CEO of Your Stake, which is a software and data firm that helps people understand their values and then see their investments through that lens. We serve asset managers and financial advisors across many of the major broker-dealers and banks with research, analysis, reporting, and our particular angle is the transparency and rigor of data that we combine with our reporting to make the complex intuitive, the esoteric personal, and help advisors tell the story of sustainable and values-based investing.
Excellent, thank you very much. We're going to kick things off today with Bib doing an overview of the rule. So I think it's hard to find a more aggressive or involved SEC than we've had in this past recent time under Gary Gensler and the team over there. One of the areas they focused on is ESG. It's been one of the hottest topics of 2022. I know there was a lot of backstory leading up to this as well. So to walk us through that very carefully and walk us through and kind of give us all, make sure we're all on the same page. Bib, can you walk us through what is the proposed SEC rule? What does it mean? What doesn't it mean, et cetera? And if you just spend 1 second too, also, because I think another place that people do get confused is the ESG rule versus the new naming convention rule they've discussed as well. So anyway, I'll turn it over to you, Bib.
Sure. Thanks, John. And you're right. The division that regulates mutual funds, ETFs, advisors, ESG has been, #1 priority, and it all rolled out in a rule proposal for both investment companies and advisors on May 25th, 2022, primarily a disclosure rule combined with a reporting rule to the SEC. And it's important because that rule came on the heels of a rule for ordinary operating listed public companies who are going to have to disclose a variety of ESG type information in their annual reports and 10Ks, 8Ks, etc. And the reason I bring that rule up, they kind of work together somewhat, that the SEC is expecting investment companies, especially, to leverage off of the ESG information found down at these portfolio companies that they invest in. Very comprehensive, as John alluded to. And it's important to also note, ESG is this is not anything new. For decades and decades, there have been ESG investment firms that have focused on that and had niche in it. I think what's happened is this was kind of a climate initiative, was huge for Biden, and it really has permeated beyond the EPA to lots of federal agencies. And the SEC was mandated or directed to pass a ESG rule. And legitimately, they've had concerns about greenwashing, and our panelists will get into that in a little bit. And so there is some probably regulatory interests in this area, and they have been doing sweep inspections. But kind of turning to the rule, you got to look at really two segments. There's investment advisors, so there's a whole host of advisors that don't manage registered investment companies. They're impacted a lot less as far as the rule is. Disclosure, like I mentioned, they're going to have to describe more in their brochure the factors, the ESG factors they rely on. They're going to have to support that or disclose what the methodology they use. And then if they're have more of an activist part, or really any ESG influence on their proxy voting, they're going to have to disclose that. I think that part has been less controversial as compared to the registered investment companies, and it would take a while to parse through the entire rule. It's very comprehensive, but I would say that if you're looking at the rule, your mindset should be with respect to an ETF or a mutual fund, how does it use ESG? Because the SEC categorizes those funds into three buckets, and then it applies certain rules to each type of fund. They call one group an integration strategy type fund, and in that case, if any one of your factors are ESG, and even if you're not even touting that it's ESG, but they look at it and view it as ESG, then you're going to be subject to certain disclosure and reporting rules. Then they call the next category ESG focus strategy, ETFs or mutual funds. That's where significant regulations come into play. And what's interesting is that they're really focused on environment versus the S and the G. And as part of that, they're really trying, I think one of the most controversial proposals is for the ETF to be reporting the GHC, the emissions of the companies, the GHG, the emissions of the portfolio companies in some way, and aggregate that and come up with a number. Very, very potentially time consuming and also costly for investment company complexes. The last type is ESG Impact Strategy. That's where a fund is more of an activist. They're trying to use the proxy machinery to change to get shareholder proposals, maybe to get new directors on companies. Of course, a fund complex could fall into all these categories. And I just wanted real quickly, because I can't cover the entire rule, but talking about the GHG emissions part of it, and I'm sure the panelists will touch on, how do you decide whether a portfolio company is doing a great job with respect to environment, with respect to emissions? How do you label a company as being, a high quality ESG company versus the other extreme? And the SEC has imported these methodology that fund complexes will have to consider in classifying, for example, emissions, scope 1, 2, and 3, and that if they're not able to find that information, they're going to have reasonable estimates of what the emissions are on a portfolio company. So I'm just drilling down into one part, but you can see why this rule has elicited a lot of comments, and also asking the SEC to scale it back. Certainly has shown up in a lot of comment letters that have come in. And the backdrop why this is serious is obviously is if in the SEC's view you're not fully disclosing ESG and your factors, et cetera, you're potentially subject to civil liability, to SEC enforcement action. So when they're mandating these strict rules, it's putting a lot of pressure on the industry to come up with some kind of way to comply with them. And the challenges of getting this data. And the last thing I'll say is, as you can imagine, it's it's probably been one of the most controversial rules to come out of the SEC in recent memory. And there are court cases, more global under the Administrative Procedures Act, whether the SEC and EPA can even go this far in regulating when Congress hasn't specifically passed a law in this area. State governments, they're saying that if their pension plans are investing, considering ESG, that's violating fiduciary duty. And then even very pro ESG parties out there are kind of battling one another and saying, well, the rule focuses too much on the E and not the S and G. And what if a company scores super high on the environmental part, but on the S and G it's low? And all of a sudden it gets stamped as environmentally friendly. So I'm glad I'm not at the SEC in this rulemaking office. That's how I'll conclude my portion of the presentation with.
Well, thanks, Bib. And you're right. I mean, first off, ESG is complex, and the rule is complex and complicated. So I think we're all going to be finding our way together. So let's start that process right now. So let's start. I like to level set for the audience a couple of the questions that a couple of areas, because ESG has, as you mentioned early, has been around for quite a while, and I think it means different things to different people. So Jeff, we'll start with you. How would you define ESG? To you, what is ESG?
So the best example that we use is a metaphor where we call ESG the GPS of investing. And when you think about GPS, you think about what it evolved from. There used to be an old map sitting in your glove compartment. You'd pull it out, unfold it, and it would give you a lot of stale data about the trip that you were about to take. It wouldn't tell you any current data. It wouldn't tell you about road closures, wouldn't tell you about detours, wouldn't tell you about traffic. So it would be these non-map data sets that were missing. And what a GPS did is it came along using big data, was able to aggregate data very quickly and be able to regurgitate it and get it down to you. And now all of a sudden you get in your car, you have this GPS, it gives you all the old data that you used to use on your map with all this new data, cops hiding in the bushes, and detours, traffic, some give weather. So you have all this more robust data. And no one ever argues that they don't want to use a GPS and they want to go back to the old map because the new GPS isn't politically correct. And that's where we get into this kind of gray area. ESG is just a lot of non-financial data that has been deemed to be material to stock price by groups like SASB and GRI that tells you that these incidents or data sets have an effect on price. Most managers across the pond and in the US all use some form of ESG data to look at the companies they invest in. A lot of the companies have been using the G data set or governmental data set forever, but increasingly all the managers that we speak with, even ones that do not offer specific, what you would call ESG labeled funds, all offer, all do diligence using some forms of ESG data sets today. And it just is growing at a point where it is not an issue anymore. And really the best thing that could happen is we could take the name away completely and just say that people are doing diligence, and that diligence includes material and non-material data sets or financial and non-financial disclosure data sets. And then the big difference, which is where we've gotten into trouble actually by our own industry, is that there's two ways to do ESG. I know there are 3 types of funds defined, but the 2 ways we would define it is you can do ESG by process. So you can incorporate data sets that allow you to do diligence about the companies you're investing in, including larger data sets than you used to have access to before. And then there's ESG by product. And ESG by product means that you're using typically a top-line data score that a company like MSCI or Sustainalytics or Thomson Reuters has put out to kind of make the absorption of this data a little bit simpler for some people. But you're using top-line data sets to either underweight bad companies based on those scores and overweight good companies based on those scores, and you're slapping an ESG label on it. And that, to us, is not ESG. And I think Patrick could probably go a little bit deeper on the nuances between those two. So I'll pass the hat over to Patrick.
Patrick, please.
Yeah, Jeff, that's right. There's a lot of different, there's a group out of MIT that wrote a paper and had since formed a whole institute. The paper originally called Aggregate Confusion. And what they did in this paper was they took all of the different top-line scores from MSCI, Sustainalytics, and others, and tried to correlate them, and the correlation was fairly low. It was like 0.3. So there's a situation where there's a number of different analysts that have their own house opinion on a stock. But when a person goes to invest, what matters to them is not necessarily what the values are of a particular analyst or their particular way of looking at it, but how do they match their values onto the investments? And so we've really taken the approach of what we kind of call no-score ESG, really just to underscore providing full transparency to people of the data and matching it to what their interests are. So how, instead of saying that this portfolio is at 8.2 out of 10, saying that there's 34% less toxic pollution compared to your benchmark, or there's 4,000 fewer asthma attacks from your endowments portfolio compared to the benchmark, where you can actually look into what are the portfolio companies of that, what are the compositions of the funds that you may hold, what are the exact factories, and what emissions are they reporting, and how do you roll that all up and display that to folks. So we really think that a lot of the backlash around ESG that may be coming out in criticism of this proposal is it's a point in time, but in the long term, we're not going to get away from people caring about what they're invested in. And like Jeff said, if we can get away with the term and get away with the connotations of this being political at all, I think we'll move forwards, because that's ultimately what people want at the end investor level.
Bib, before I turn to you for the same question, so it reminds me, I mean, ancient, I studied accounting and got my degree in accounting, and the first thing we were taught is, debits and credits, and looking at the, different kinds of accounts, et cetera, and the numbers, the accounting flow and how the income statement flows into the balance sheet and the statement of retained earnings. And then we started to focus on the notes of those financial statements, which elaborated on those things. And then we started to further focus on the management discussion analysis. So a number is a number, but the notes and the MDA and those things give you a perspective and a quality and a richness around those numbers that you need to really look at and need to understand more. And I think, Jeff, as you put it, the advent of looking at the GPS from the old map, a map is a map is a map, a coordinate on a grid versus all the other data around it and how rich that is, still early days. There'll be a lot of movement here. And as usual, and I don't think there's any other way around it though, but as usual, the regulatory regimes are coming to this 10 years after people have already been implemented it, which is why, like, boy, if we could have a whiteboard and start over again, we would probably do it a lot differently, but we're not in that position. So Bib, when you think about ESG, how do you think about it? And how do you talk to your clients about it?
Well, one thing I wanted to mention was the name test rule, which you brought up, John, and that's the challenge here, because I draft prospectuses all the time, and so you want to capture what the strategy is, and that's very subjective, and that's what the investor really wants to know. Unfortunately, in some cases, you have to overlay SEC disclosure requirements, and it starts detracting from that language. So, and it also you lose flexibility in how you can manage the portfolio. So, in the name test, if you have ESG in it, under a sister rule, 80% or more of your assets will have to be invested in portfolio companies that are based on this ESG factor. Well, right there, if for some reason was in the interest, you think, of your shareholders to go below that 80%, then you're handcuffed. You have to stay above it because of this arbitrary percentage. And then the other part is, let's say there are a variety of ESG factors that you considered. Now you're going to have to devote a lot of that white space, and you don't have a lot of room in a prospectus to addressing these specific rules on carbon emissions and things like that. So it's a struggle. You have to advise clients first and foremost. We want to know. You need to communicate, because your prospectus is also really a marketing piece, what your strategy is, and then we got to add in what's necessary to meet the SEC disclosure rules.
Yeah, I agree. We've all seen advisors who are just stepping away from the controversy altogether, pulling ESG or any of those terms out of their names, out of their strategies, because it's just too hard right now to navigate everything and comply. A term you mentioned early on, Viv, and I think it's a critical term too, that people think they intuitively know what it is, but let's just talk about it just for a moment here. So let's kick it off, and Jeff, let's start with you again and go with greenwashing. So can you kind of talk about what greenwashing is so people understand and make sure we're on the same page of what greenwashing is? And then again, I'll go to Patrick and Bib.
Yes, so greenwashing really refers to the marketing of light ESG or light impact products or funds. So basically refers to stating something in the name of the fund that can't be translated when you look under the hood of that fund into reality. A good example, and you've seen this in Europe and now in the US, is that a lot of funds that put ESG in their title 2 or 3 years ago, all of a sudden over the last 2 or 3 years have been pulling those titles off because they understand inherently that they can't back up what they're actually doing. It also, when you look at a lot of passive funds of some of the, I won't name names here, but some of the large asset managers, they've taken an index and they've added top line scores from one data provider and underweighted and overweighted some stocks in that index, added 45 basis points to the cost of that fund, and slapped an ESG label on it, and now start marketing it out. There's no additional diligence being done. There's no additional work being done. And it's extremely profitable, both to the companies marketing those products and to data providers that are actually providing those top line scores. It's become a very, very profitable business. And if you go back and look at some of the older European companies that don't have ESG anywhere in their label, you can look into their prospectuses and see that they've been doing ESG diligence for years without any top line scores, with their own data sets and metrics about what's important to them. And when you bring it all the way down through this political lens that's now coming, what you have to ask yourself as an end investor is there a material impact from environmental, social, and governance factors that can affect stock price? And do I want my portfolio manager looking at that data? And I don't think there's a better example of this than PG&E in California, because Pacific Gas and Electric was converting more customers to renewable energy than any other utility company in the industry, partially because of the populous state that they're in, and partially because of California regulation. So they were kind of being rolled along and not forced to do this, but being pushed along by their circumstances. And every single ESG by data metrics or by top line scores passive fund had PG&E in their portfolio. Active managers, though, were looking under the hood at those top line scores and seeing that PG&E was self-disclosing on an annual basis since 2017 that their risk of fires due to droughts in northwestern California was off the charts. There wasn't a utility in the country that had anywhere near the fire risk that PG&E had. And most active managers, over 83% of them, avoided PG&E in their portfolio because they were looking at this additional data set. That you couldn't find that data in the traditional books or the traditional filings that a company has to put out, but to look at that and say that wasn't material and that you wouldn't want that lens on your investment would be crazy in hindsight, because look what happened to the company and the cost that the company faced.
Patrick?
Yeah, greenwashing is a really big issue, and it's partially a data issue and partially a marketing issue. And I'll pull up another example, which Bib highlighted at the beginning as one of the more controversial aspects of this proposal, which is the greenhouse gas emissions disclosure. There's already tons of, dozens and dozens of low carbon funds out there, passively managed low carbon indexes, fossil free indexes. With the emissions reporting, the reality is that a lot of these indexes are using data in such a way that it's not actually capturing the full picture. And it's a challenge to do so. So with greenhouse gas emissions, there's scopes 1, 2, and 3 in the way that they're categorized. And scopes 1 and 2 correspond to the activities of a portfolio company and their operations. Scope 3 incorporates what their products do downstream, what their impact in the world after they've made the sale. If you think of like an airplane manufacturer, those planes are used for decades after they're produced, and so companies' operations can come from the scope 3. But the portfolio companies are not yet required to themselves disclose. And so there's a number of voluntary disclosures from a very small fraction of the portfolio companies, but those voluntary disclosures aren't necessarily audited and are very uneven in the way that they're conducting their own calculations. So we have a situation where there's already a lot of investment companies offering these solutions and doing the best that they maybe can in some cases, maybe pushing the easy button. And the data in terms of the actual disclosures is sort of a catch-22 scenario where it's not being reported in a publicly available manner by the underlying companies. And there's no regulatory agency really standardizing or auditing the collection of that information or the calculation of it. So this proposal in requiring the funds to calculate and report on it really does need to go hand in hand with the proposal previously for companies to disclose it and for that to actually come into enforcement. And in the meantime, you're stuck in a scenario where there's still investment products that are marketing this and may not really represent the full picture unless there's someone at those firms really taking a careful eye and thinking through all of these nuances and the way that they're adjusting and estimating their portfolio construction.
Thanks. So you guys both hit some really interesting points. And Bid, before I turn to you, I want you to kind of look at it from a slightly different lens. You both mentioned data, and I'm an old veteran of the data wars. And it's a great model if you're a data provider because you sell the data to somebody who's going to use your data to create a product, and whether it's an index or other data. And then anyone who wants to figure out that and look at it has to also pay you for that data, which can be very, very expensive. So there's not really equal access across the board for data, and it's all in the data. Is exactly how people are looking at these subtleties and these nuances, et cetera, as we look at it. And Bid, there's another proposal, and I don't want to spend time on it, but how the SEC is contemplating starting to regulate index providers, and I think that's more of looking at the data piece of it, but the index providers, et cetera. But from your experience, 40-Act lawyer for all these years, et cetera, data has been and continues to be a challenge for the industry of making sure that everyone has access to the data, and people understand. We have generally accepted accounting principles. We have this, but we don't have. No one is regulating or looking at the data providers, and I'm not promoting that they do, but I'm just saying. But there is a challenge with access to data, so that the asset managers and the investors all have access to the same data. So if you want to just comment on greenwashing in light of ability to access data.
Yeah, no, I think that's critical, and I think you have to look at the world too. I mean, there's some ESG shops that do tremendous research. They hire people that have the expertise, and I can understand their frustration when they're showing up on searches with some other shops that decided that they need to get on those searches. So their marketing people may be saying, look, we can't even submit an RFP, unless we have some kind of ESG product. And then those are the ones that are probably have more of a temptation to reach outside and use a third party, either to provide them with some kind of ESG scoring, or maybe come out with an index fund. But they don't have the internal expertise or really the desire to devote resources to really making sure that their product, their fund is ESG. Yet they may pass all these hurdles that have been just proposed by the SEC. So I think that's a big tension, and I think some of the comments to the rules proposals address that.
Good, thanks. So Patrick, I want to switch to you for this one. And so stepping back, ESG has been around a long time. We keep talking about it. Everyone's talked about it. Why are we talking about it? So from your perspective, how does ESG create impact? So so once you step back from that perspective.
Sure. I think the fundamental reason that we're talking about it is because people want to create impact with their investments, and people may have different ways of looking at that, but it's really astounding. In surveys of investors, there's one recently by Morgan Stanley, 85% of those surveyed of mass affluent up through ultra high net worth are desiring to have alignment between their investments and impact. And it's even higher among millennials. So that's across all ages, and it's 93% among millennials. And that's a figure that I always think about because I don't think there's 85% of people who agree that Elvis has died. There's or that ice cream is good. And the reality is that right now, about 10% of people, according to the CFA Institute, are actually invested in intentional impact vehicles. So there's a lot of talk, but there's a huge gap yet to be bridged between what people want and where they are. A lot of that gap is the fact that people aren't sure exactly what it means, because it may mean something different, slightly different to different people. A lot of the problem is that people don't maybe trust that they can do it, and they can't see the effect, in an esoteric investment vehicle. How can you quantify impact? And then from the investment advisor perspective, who's guiding people through these conversations, if investment advisors aren't trained on these issues, or a client in a conversation asks a question that they may not be able to answer, or if they have to point to a top line score of a 4 out of 5 or 8.2 out of 10, and then explain the entire methodology of econometrics and everything to their end client in order to get them to understand that that's a pretty daunting fear for an investment advisor. And that's really where we think the solution is, and where we try and help is providing that transparency in a way where you can have everything based on sort of watertight data that's independent, rigorous, publicly available from government agencies and so forth, as opposed to subjective analyst sort of secret sauce, and expose that in the context of the conversation, and sort of bridge that issue that you were just talking about around just getting access to the data being a hurdle of lack of transparency, which can prevent people from trusting the data or trusting the process.
Excellent. Thank you. Jeff, same topic.
So, I mean, it's an interesting point, and to Patrick's point, I read yesterday that 20% of the people still believe that there were no dinosaurs in the United States. So you have to be careful about trying to please all of the people all of the time. I think what's important is that people need to understand that ESG is a measure of what these factors can impact a company that you're investing in. So it's an outward looking in measurement. It is not a decision maker. It is not exclusive by any means or any nature. ESG does not exclude fossil fuel companies. You can get full ESG data sets on all fossil fuel companies. It tells you which fossil fuel companies might leave a better environmental footprint, but more so, it tells you which fossil fuel companies are more impacted by environmental lawsuits, which ones have had board issues, governance issues, which ones don't treat their employees well. If you narrow it down to that for an end client, I've never had a client say, oh, I wouldn't not be interested in having that data about the companies that I invest in. But ESG is also not by itself impact. Patrick provides additional data through your stake that allows you to see the impact that those companies might have on the environment. But ESG is specifically outward looking in. It tells you the impact that these decisions a company makes might have on that company's performance. It ultimately does not tell you the impact that that company has on the environment or on the world around it. So people that are saying that ESG is woke capitalism, by definition, ESG does not make any decisions about anything that you should own or not own. It's just a broad additional data set. I just want to make sure we really hammer that point home, because it's the nuance by which it's become political, and it's not an accurate political statement, or it's not an accurate statement at all to even make it political. If you really want to look at impact, then the SEC has to start going further and mandating Scope 1, Scope 2, Scope 3 disclosures on companies, but I think they're going to get an enormous pushback from it. I don't know if they have what it takes right now to actually pass, especially on Scope 3. I think you'll get more definitional guidelines on Scope 1 and Scope 2, but ultimately it's a huge hurdle for companies in and of itself to actually, the end companies, not the mutual fund companies that also have to report on what the underlying companies are doing, but it's a huge hurdle for mid and small sized companies to even begin to measure this. So it'll be mostly relegated to large companies. And then you'll get into this factor that BIB will have to deal with of, if you're a mid or small cap fund, can you ignore a lot of the SEC rulings because they don't trickle down into smaller size and mid-sized companies? So it's still a bit of a problem area for the SEC to come through. I think they'll be really strict on what the naming functions are and what the marketing around greenwashing is. So if you say your fund does something, you better be able to back it up. And as an advisor, if you say that you provide certain types of portfolios for end clients, whether they're impact driven or ESG driven, you better have that really well documented in your compliance folder, and you better have a diligence process that can show that you back up what you actually say you're doing.
And again, I keep doing this to you, Bib. Before you answer, before you throw your 2 cents in, one of the things that Jeff pointed out and Patrick mentioned as well is it takes a lot of work for companies to provide these kind of disclosures, and it's going to take more and more work and transparency. And from my 30 plus years in this business, it's getting harder and harder to be a public company, getting more and more expensive to be a public company. And it's one thing for those ginormous companies to go ahead and do this kind of work. That's cost of doing business, they can do that. But if you're a small and mid-sized company and you're starting to add up all the different reasons, all the different expenses you have of being a public company, you can seriously start thinking about whether or not you should have remained private or looked at other funding. So as you think about, as you answer, Bib, talk about that issue about, we look at seeing the IPO market, seeing the SPAC market. We've seen a lot of changes in capital formation. And it doesn't change what the big guys do, but it certainly seems to be impacting smaller, medium, mid-sized companies.
Yeah, and we've seen that, with Sarbanes-Oxley, and even the impact on larger companies. It gives them more the impetus to go private. But yeah, obviously this is a need. I think Patrick, those statistics that he brought up. I think the old mindset of you invest for alpha and that's it needs to be addressed, because especially as you go down to younger investors. And I think, and thus, I think there should be a regulatory initiative here. I think it's probably going to be that the rule is scaled back, and that you really need to focus. The SEC has other tools. They have, of course, a big tool, enforcement, but they also have inspection. And there's also, with the regulated products, FINRA, lots of rules or efforts more focused on the marketing and the messaging, and even investor education. and less on trying to throw a Hail Mary that some rule is going to be able to address and solve all these really complex issues here. I think that's unrealistic.
So as we head to wrap up here, so my one conclusion I have is I draw up that 85% of Americans have seen Elvis riding a dinosaur eating ice cream. I think that was the thing that came up with, but anyway, I just jest, obviously. So last comment. So let's wrap it up. So we'll start with you, Patrick. Just any last words for our audience today, and then Jeff, and then Bib, and then we can get people back to their day.
Yeah, I'm really curious to see how the rule becomes finalized and what sticks and what changes. But the takeaway that we have is that people want Elvis. You know, they want to have impact, they want to align their investments with their values, and they want to have great returns and make sure that all their managers and advisors are doing the proper diligence on the things that matter in the world, which everyone understands to include a variety of other factors. And the other thing that I'll throw out here is that this is also happening across the world, not just in the United States. The European Union has the MiFID II requirement, which has been on the books for years around risk suitability for advisors to make sure that they're recommending products that are suitable to each person's risk profile. And just in August, a couple months ago, it came into effect, the addendum for their sustainability requirement for suitability. So now every financial professional in the European Union is on paper required to ask all clients whether they're interested in aligning their investments with sustainable outcomes, and then walk through a process and then show transparently how the portfolios they're recommending are a best fit. And the EU has its own way of creating a taxonomy around the indicators and data that they are encouraging companies to report and investment companies to aggregate. So I think whether or not the timing is the next year or the year after, this is going to happen, and the costs of doing it, the administrative burden, are, I don't think, particularly large in the face of the opportunity, and in the face of all the new technologies and data solutions that are coming out that are just getting more and more affordable for both professionals and for the end investors.
Great, thank you. Jeff, your final thoughts.
I would say as a company, we always want to have more and more data to be able to analyze the companies that we're investing in. And we want our managers that we invest in to be able to do the deepest dive possible on companies. Unfortunately, non-material data sets have an impact on stock price. And last, don't just get sidelined around GHG emissions. We also have a resiliency issue that needs to be invested in, and the IRA bill, whether you like it or don't like it, provides $369 billion of funding towards new water infrastructure, new sustainability infrastructure, new roadways, new pipelines, and investing, and also big support for renewable and battery technology domestically. And not investing with that tailwind behind you, to us, doesn't make any sense. There are plenty of fossil fuel companies that are also investing in the transition economy. So this is not a question of not wanting to own fossil fuel companies. They are needed in the transition. We're not advocating for that. But to be able to look at companies that are profiting from this type of transition that we're in is incredibly important. And it wouldn't, fossil fuel companies wouldn't be doing it if it wasn't profitable for them too.
Absolutely. Bib, last word.
Yeah, I try to be optimistic, and it may be something in the long term. What it's bringing to the forefront is that there's opportunities for investment products that address externalities. You know, people always talk about there's so many more mutual funds and ETFs than actual stocks, and that's true. But there's so many more variety of important factors to an investor beyond alpha. And so maybe even in the S and G part of this, you know, this may end up being kind of a framework and also be an impetus to launch more financial products that may address different things. Companies that somehow contribute to societal problems, you know, like drug use, things like that. That this would be a beginning kind of framework on how realistic you regulate such products to make sure, you know, they're as pure as possible, and it's not the marketing department trying to capture a new investor base.
Thank you. Obviously, we could have spoken on this topic for a couple of hours more. And Patrick, you're right. We hardly touched the international implications. So this is still early days, and so I think that it would be great if we could reconvene this group sometime in the future and just discuss what has been playing out and what we'll continue to plan in the future. Obviously, all of us can be reached through our firms, etc. So, but I wanted to thank you guys. You guys did a great job. I learn something every time to make my job easy as a moderator, just to get 3 smart panelists and let them do their job. So thank you very much. And Thompson Hine will be making this recording available. So thanks, everyone. Appreciate it. Bye-bye.
Thanks, John.
Thanks, John. Thanks, everybody.